Go back as gold is skyrocketing this year. Again, as we said, gold has to stabilize above the $4,200 an ounce. And the lower economies go, the higher gold prices go. So we could see gold easily over $5,000 within the next maybe 5 months. It could definitely go above that, or even less. And the same with silver is going to keep going up. And now when interest rates go down, inflation is going to go higher again. And again, the higher inflation goes, the higher gold prices go. Look, if cryptocurrencies were in here, gold right now would probably be about $7,000 an ounce.
Fundamentally, I think we are in a secular bull market, and I've indicated I think the top is probably around $6,000 an ounce. So it's got a ways to go.
Economic forecasters Gerald Celente and Steve Hanke highlight the extraordinary momentum unfolding in the precious metals market. Gold has been surging all year, and they stress that the key confirmation now is stability above $4,200. With global economies weakening, they argue the historical pattern remains intact. The lower growth falls, the higher gold rises. That dynamic alone could push prices past $5,000 within months, possibly sooner. Silver follows the same trajectory, benefiting from the same macro pressures. As rate cuts return and inflation reaccelerates, both analysts emphasize that gold's bullish momentum will continue to strengthen. They note that if cryptocurrencies weren't siphoning speculative flows, gold could already be near $7,000. Structurally, they maintain we are in a long-term secular bull market, with an ultimate top forming closer to the $6,000 range, still far above current levels. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
No, this time when the markets crash, it's going to be real and they're not going to be able to turn it around. And it's just going to keep getting worse. Way overvalued, to quote Magnificent Seven. And they're not going to be able to change it. It's going to be this is going to be the greatest depression. This is going to be the worst we've ever seen. It's been artificially propped up for a decade, and they only could do so much for so long. And again, they're going to lower interest rates. That's the guess on the street. The lower interest rates go, the deeper the dollar falls. And the deeper the dollar falls, of course, the higher gold prices go up. Gold's dollar based, so the currencies go up. It's cheaper for other countries to buy gold. And again, look at what's gold is going on. I mean, you look at our Trends Journal cover, top trends for 2024. We said it would be a golden year for gold. And it was. Gold went up, last year was almost 30%. And this year it's up, almost over 50%. And again, go back to October 16th of this year. We said there's going to be a correction in gold by about $500 an ounce. And it did. Nothing goes straight up, and it's going to be a correction. And now we're saying gold has to solidify over $4,200 an ounce, solidify, and then it goes up and hits another new high. Okay. That's the way we see it. As gold is skyrocketing this year, again, we only put the facts in. We subscribe to the Wall Street Journal and the New York Times. Not one word about spiking gold prices for months. Yeah. For months, not a word. Because gold spiking is telling you how bad things are. It's the world's #1 safe haven asset. And there's no comparison to why gold prices are going up now compared to then. Back then, America was #1. Nobody was close to us. China had a gross domestic product of about $150 billion. India, about $120 billion. United States, it was like over $5 trillion. Over $5 trillion. Now, what's China's GDP? About 20 trillion. Oh, you mean they went from 78, they were only 150 billion, and now they're 20 trillion? Yeah. Oh, and what else? Here. The reality is much of the world has had enough of the United States geopolitical and economic hegemony. They've had it. The BRICS control 40% of the world's gross domestic product. 40%. They've had it. There's going to be the death of the dollar. And again, the lower interest rates go, the deeper the dollar falls, the higher gold prices go, and much of the world has had enough. We are not the same country we were in 1978. It's a whole new world. It's going to make it worse. When the markets crash, reality then hits the street. And there's going to be a bust. There's no question about it. The P ratios are way overvalued in these high-tech firms. And gold is going up because the world sees what's going on. Again, you got to look at, as I said, Brent crude. What are you talking about? A little over $62 a barrel. And what are they doing? The OPEC plus companies putting out more oil as demand is going down. and putting out more supply because they need the money. Look what's going on again in Japan, the fourth largest economy, in a recession numbers. Again, the GDP was down the third quarter. And Germany, the third largest economy in the world, largest in Europe. Everything is slowing down. It's all artificially being propped up. Again, the bigs keep getting bigger. By the way, each week in the Trends Journal, we have it. Bigs getting bigger. The merger and acquisition activity is flying way back up again. And again, all they want is cheap money. And again, if they lower it, again, not my language, look it up. They're talking about why the markets are going up right now because of the confidence that the Fed's going to lower interest rates in December. So the lower interest rates go, the higher inflation goes too.
Yeah.
And again, when you put the real inflation numbers in, they started rigging this in the 80s and the 90s. I talked about housing prices going up 50%. No, we don't do that anymore. We put in other costs that have gone up, so we don't put that number in. They rig the numbers, so they're much higher than they are. And now when interest rates go down, inflation is going to go higher again. And again, the higher inflation goes, the higher gold prices go. Look, if cryptocurrencies were in here, gold right now would probably be about $7,000 an ounce. First inning of a much larger move. Again, silver is being used from high tech to heavy industry and everything, right? Your computer goes out, your phone goes out, you throw it away. There's no reserves. And it's being used more and more. With gold, I got my gold ring over here. If I wanted to melt it down, if I needed the dough, you melt it down. You don't throw it away. So there's going to be more and more increased demand for silver in heavy industry and high tech. And again, it's the high tech world that's going to keep going up. And again, the major reason why gold prices are high is because gold is the number one safe haven asset. And there are geopolitical and socioeconomic fears around the world. And that's why it's going up.
Yeah.
And again, it was it's a fact. Everybody could look it up. Not a word about it in the mainstream media as prices were spiking this year. Not a word until it got around, $4,200 an ounce, 4,200, excuse me. Then they started saying, look how high it's gone up. Oh, you're talking about the equity markets going up? How about gold going up?
Yeah.
Way much higher than the equity markets, and silver. Again, as we said, gold has to stabilize above the $4,200 an ounce. That's the way we look at it.
Right.
And once it does, it goes to a new high. And it's just going to keep going up. We don't see it going down, and it'll stay high. And you're going to see more and more failures of economies. And the lower economies go, the higher gold prices go. So we could see gold easily over $5,000 within the next maybe 5 months. It could definitely go above that, or even less. And the same with silver is going to keep going up. So we're very positive on both of them.
Gerald Celente warns that the next market downturn won't be another temporary dip. It will be the one they can't reverse. He argues the economy has been artificially propped up for more than a decade, leaving valuations stretched and major indexes dependent on a handful of overhyped tech names. As he sees it, falling interest rates will accelerate the dollar's decline, and that decline will continue pushing gold sharply higher. Gold already surged nearly 30% last year and more than 50% this year, proving its role as the world's primary safe haven asset. Celente also stresses how global shifts, BRICS expansion, weakening Western economies, and rising geopolitical tension are reinforcing gold and silver demand. With economies faltering and inflation poised to rise again, he believes both metals are heading far higher. Let's get into the interview.
It is consolidating around 4,000. It seems to be stuck in like flies on fly paper around 4,000 and consolidating pretty well. But if you look at the expectations, the call contracts, the options for calls are greater than the puts by a considerable amount, and that signals that it's going up. People in the market think it's going to go up in the options market, so that would be one point. Fundamentally, I think we are in a secular bull market, and I've indicated I think the top is probably around $6,000 an ounce. So it's got a ways to go. The dollar-euro rate's been very, very stable and not moving very much. And the 10-year is just a tad over 4% now. It's it's been pretty steady too for not all the time since we talked, not for 5 months, but certainly for the last month or two. It's been hanging in there just around 4, a little over 4. So the markets have those markets. If we look at gold, since it pulled back from its high, it's been steady at around 4,000 and consolidating. This is for, let's say, the last month, and the 10-year has been around 4%. That's pretty steady, just a little over 4.1, and the dollar euros, it's around 115, 116. Pretty steady.
Gold's recent behavior reflects what Steve Hanke describes as a steady, controlled consolidation. Prices remain magnetized around the $4,000 level, holding firm despite volatility elsewhere. Options positioning shows a clear skew toward calls, signaling that market participants overwhelmingly expect the next move to be higher. Hanke views this as confirmation of a broader secular bull market, one he believes could ultimately push gold towards $6,000. He also notes the stability surrounding key macro signals, the dollar-euro rate barely moving, and the 10-year treasury locked just above 4%. That combination, steady bond yields, steady currency action, and gold refusing to break lower, suggests strong underlying demand. With gold consolidating tightly after its latest pullback, Hanke sees the market preparing for another leg higher rather than a breakdown. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.